Hi, I'm Pete Grupposso, Vice President of Dealer Sales for Manheim, and this is another edition of Manheim Connected. I'm joined again by Kevin Chartier, our Vice President of Consulting, who's going to share a little bit about where the market is, call it a state of the market right now. So welcome, Kevin.
Thanks, Pete. Good to be with you again today.
Well, thank you for joining me. And what we've seen since our last call, which we had probably about a month and a half ago, is where we've gone from talking about how deep the market is diving to really seeing what feels like a strong recovery. Retail sales are very, very strong right now. We're seeing significant demand on the wholesale side to fill that need on the other side of the retail piece. So it starts to feel what I would call cautiously normal. What are your thoughts? Are we back to normal, or is this just an upswing? And are we in a V, or are we in a W-shaped recovery here?
Yeah, that is the million-dollar question, or multi-million-dollar question, Pete. Honestly, as I look at the volatility we've seen over the past 2-3 months, the level of volatility here is clearly unprecedented. It's to the point where I'm not really sure what normal is anymore when you start to talk about the year 2020. When we look at the speed of the decline post-COVID versus the speed of the recovery, it's just been an incredible ride on either side of that V-shaped recovery. Going into this crisis kind of mode and the lockdowns that we had in mid-March, the marketplace was running about 5% up in terms of retail used sales year over year. A very nice, strong spring market. Values were up, 2 to 3% year over year. So very typical strong spring tax refund selling season. Then we hit the brakes and an incredible crash. I think the last time we got together, we talked about marbles rolling off the edge of the table. And we clearly saw that all the way into the middle and end of April. When we look at what happened to retail sales, they declined year over year by about 60% at the bottom there in mid-April. Coming off of highs where we were running ahead of prior year, just a staggering decline. Same thing happened to resale values. They fell by about 11% over the course of a 4, 5, 6 week period of time. So both of those trends are clearly unprecedented historically. They make the volatility we saw in the great financial crisis of 2008 look like a mild ride. So just nothing in history compares to what we've seen over the past several weeks. Of course, once we bounced off the bottom, we talked about marbles rolling off the table. Well, now it looks like a golf ball bouncing off of a concrete floor, right? So we've seen retail sales recover. We crossed over the 100% year over year mark around mid-May. And as of the end of June, retail sales for used vehicles are running about 20% ahead of prior year. So just an incredible recovery and dwarfing where we were in a very, very strong spring market. So again, unprecedented would be an understatement. When we look at resale values, we've seen the exact same kind of V-shaped recovery. Resale values bounced off that bottom, down 11%. They've been steadily climbing week over week for 9 straight weeks. We are now about $500 higher on average resale value than we were prior to the COVID crisis in the spring market. So fully recovered in terms of resale values and then some. And when we look at our values year over year, we're back up year over year, somewhere in the neighborhood of 3.5 to 4%. So a little bit stronger than we were in that very strong spring market. So when I look at, all the stats, normal, yeah, I'd have to say that we crossed over the normal barrier somewhere in mid to late May. And we might actually in June have been in a territory that I would call heated. So incredible. Now when we look at the new car market, not quite the same, right? Certainly there's bigger challenges in that new car market. When we look at the production numbers and things like that, new car sales running about 25% below prior years still. So they're not fully recovered. Production got shut down in mid-March. We've gone for 6 to 8 weeks now with very limited to no production. In April, light vehicle production in North America was only 8,000 units when it's typically 1.4 million. So significant number of cars that did not get produced in April. Likewise, in May, we ramped the machine up to about 248,000 units versus that 1.4. So significant hole in terms of production has built up over the past 8 weeks or so. We look at it year over year. We're over 3 million units down in terms of production from North America, and that will create a significant supply chain issue on the new car side. And in fact, we are starting to see some of that in terms of day supply of inventories at dealers. We're now probably 10 or 12 days below where we were heading into the COVID crisis. So we're starting to see some shortages of the popular models and things like pickup trucks and popular equipment packages. And I suspect that as the supply chain recovers, that we're going to see those problems accelerate as we go through the summer and into Q4. When I look at inventories on the used car side, they're not a whole lot better, right? The dealers were very disciplined in terms of inventory acquisition throughout the crisis. They have driven their days supply down from about 40 to 45 days, which is normal prior to the COVID crisis, and currently sitting down in the neighborhood of 30 to 31 days. So very, very tight retail used vehicle inventories. And kind of a just-in-time management philosophy on the dealer side in terms of replacing inventory, which has worked fine because we had this huge glut of inventory sitting at auctions that kind of drove up during the break period in the mid-April timeframe. So what we saw was about 150,000 incremental vehicles on ground at auction following the COVID lockdowns. And now as we look back over the past 8 weeks or so, we have liquidated that entire excess supply of inventory. Even the rental cars are down now versus where they were prior to the COVID crisis. So we now have inventory levels that are below where they were back in early March prior to the lockdowns. And we're starting to see some scarcity of supply on the wholesale side as well. So I expect that we're going to see some challenges with availability on both new and used car side throughout the month of July. It will self-correct. There's a ton of repo forbearance vehicles, some delayed off-lease decisions from consumers and things, and those vehicles will probably start working their way into the market here over the course of the next 5, 6, 7 weeks. We think that there's about 300,000 to 350,000 of those cars that will work their way into the auction and remarketing channels here over the next several weeks, but they're not likely to arrive in time to really affect availability for July. So I think we're going to see a little squeeze here in July, followed by availability improving in August, which means, of course, resale values are likely to stay relatively high through July and then may taper off as these incremental supplies hit the marketplace in August.
Yeah, so there's a lot going on, and I think the golf ball off the pavement is a really good analogy, because I think anybody who's seen it, it's a skyrocket, right? And there's a lot of different things influencing the marketplace right now. One thing we've seen a lot of talk about recently is vehicle values, and you mentioned it at the end. They're high now, and they'll very likely hold up until supply starts to flow back through. A lot of conversation amongst dealers about how much is too much. And I think a combination of the demand, the lower supply, as well as just values correcting themselves from historic lows are driving it. And I think you're seeing a balance between, dealers getting aggressive where they need to acquire inventory, but the day supply tells a story that doesn't sound like too many people are overbuying or overstocking at this point.
Yeah, not at this point, right? So, there's a tremendous amount of stimulus money that has been poured into the market over the past couple of months. And all that stuff is starting to come to an end, right? So the CARES Act expires here at the end of the month. We still do have 20 plus million people on unemployment. We still have record levels of unemployment claims week in and week out. So we are looking at kind of depression era levels of unemployment that we obviously haven't seen in 100 years. We're starting to see some issues with the virus and some hotspots popping back up. There's concerns about what we may have to do in terms of containment around that virus again as those hotspots flare up. So we've got this new vehicle supply chain challenges, and on top of that, we've got social unrest. So, is there any more volatility we could add to the system here, Pete? It's just an incredible amount of uncertainty as we head forward. So anyway, my best guess when we look at all of these factors together is that we're looking at a marketplace that's beginning to plateau from a very, very hot position in June. July will likely kind of stabilize a little bit. And then we'll start into that normal seasonal down pattern that we typically see as we head into the fourth quarter. And my guess is that's what we'll see again this year.
Great. Awesome. Thank you, Kevin. And one last question, because we heard a lot about the new car and then, the impacts that'll have obviously on the late model cars, but the under 10K has been an interesting market to watch here for sure. What are your thoughts on that under 10K market? And obviously we've got good experience in that market selling. I think it's, 1 million cars a year in that segment. What are your thoughts there?
Yeah, that is an interesting segment, and you probably know better than I do. We've heard a lot from dealers about the difficulty in terms of executing purchases in that segment of the market with those vehicles without being able to see the car run and touch the car as it runs through the lane. I mean, obviously, this virus has driven us to a position where we've had to do a lot of things we're uncomfortable with, a lot of things very, very differently than we've ever done in the past. And it's forced us to do it in a very, very quick period of time. So this subsegment of the market, I can share some of the dealers' concerns regarding availability of these units and how they have to go about buying them. That said, when we look at what's happening both in that segment and overall, we are selling 95,000 units a week in a primarily digital environment, right? As we begin to try and work our way back toward what I'll call a more normal way of selling vehicles. We're still dealing with significant restrictions, locale by locale, state by state, in terms of what we're allowed to do, how many people we can have in one van driving around the lot to move vehicles, and all those sorts of things. And again, this subsegment of cars is probably most affected by that, more so than pretty much anybody else. And again, the swiftness and steepness of the decline and rebound in this market has just been absolutely breathtaking. When I look at the under 10K segment, just a couple of quick stats to kind of put some context around it. It's about 20% of our normal volume. Like you said, we sell about 1 million of those a year. When we look at prior to COVID and where we're at, like everything else, those were up about 5% year over year in terms of volume. So a very strong spring market. But they did drop more than the market as a whole. The market as a whole kind of bottomed out, somewhere in that down 75% range. Well, these were down probably 80% year over year in terms of volume. And when we look at where they're at now, the volume there is only down about 14% year over year, and that's pretty comparable to what we see with dealer sales in general at the auction. Pre-COVID, when we look at values, MMR retention on these vehicles was running just under 100% at 99.7. At the bottom, again, it dropped even more than the 11% we saw on average. It bottomed out at 85-ish% of prior years, so that's a 15% decline pretty quickly. Crossed over on the way back up in mid-May at the 100% mark, and now it's running at a red hot 108% of MMR. So MMR has just had a heck of a time, both on the downside and the upside, trying to keep up with this marketplace and the speed of the change and the magnitude of the change that we're seeing. When we break out kind of take a look another layer lower at even the under 5K segment, that's even been more volatile. And right now, when we look at its MMR retention, those cars are selling for about 110% of MMR. So folks that are coming to the auction with the expectation they're going to pay MMR on these cars are getting a bit of a surprise that their dealer partners are paying significantly more than that for these vehicles. And MMR is, again, trying to catch back up. I think we talked about this the last time, that because of the volatility on the downside and our expected volatility on the recovery, that MMR retention was going to be a critical item for dealers to keep an eye on for several months, and that has proven to be true. When I look at just some of the other stats here, Pete, we look at the bids per unit that we've seen at auction on these vehicles. Prior to the COVID crisis, we're averaging about 9 bids per car sold. We bottomed out in April, only getting about 4 bids per car sold. And now we're almost at 11 bids per car in the month of June. So just a significant uptick in terms of dealer interest in the inventory that's being sold. And of course, that's what's driving these really, really high prices. It's the price discovery of the competitive bidding environment that's driving this. Lane efficiency, when we were pre-crisis, running about 51% on these vehicles. At the bottom, only 20% of what was offered was sold. And now we're in the neighborhood of 70% of what gets offered gets sold. So just I mean, it's like a super ball or a golf ball bouncing off the concrete floor. And again, in this sub segment, it's been even more volatile. So I'm just curious, Pete, what are you hearing from the dealers in terms of how things are going in these segments?
Yeah, I think you summed it up well. I think inventory is hard to come by, specifically on the later model stuff. I mean, without a doubt, the new car production slowing has forced a lot of clients into absorbing more off-lease units at the grounding point, so they're not flowing into the market as well. And then that under 10K has been an interesting one. Those cars come in, they leave as fast as they get to the auction. They're in high demand, and I think the biggest thing clients are looking at is they're trying to balance between not getting left out completely and leaving an auction without anything and not overpaying, which really is what they're always doing, but I think it's heightened right now. For our sellers, I think our sellers with the 7,500 and below, they pretty much show up at our sales recently knowing they're going to sell 85 to 95% of those cars and get good money for them. And so I think that segment's just really performing very, very well. I think the CARES Act and the stimulus money obviously is driving that market significantly at this point. So the one thing you mentioned here is, there are challenges with buying those cars. And one thing we've done at Manheim recently is, we tried to get previews set up at all of our locations, which we've now accomplished. But one of the challenges was vehicle staging. It was just hard to find cars. And at many of our sites, we've made some significant changes the way the vehicles are set for sale. Really going back to more of again, we'll use the word normal, but feels a little bit like it used to in terms of finding cars is pretty darn easy right now. Matter of fact, yesterday, I'm at Manheim, New England right now. Yesterday, they had about 150 clients come preview cars, put their hands on them, look at them, and right now, just as I'm sitting here, the majority of those cars are selling. So it's been unique. I think dealers showed a lot of patience mid kind of COVID shutdowns, and they're similarly showing good business decisions right now while still maintaining an aggressive tilt towards them. So it's been interesting to see, to say the least.
Yeah, Pete, I think that's wise for the dealers to approach this market with a good bit of optimism as well as prudence. The level of uncertainty as we go forward from here is just off the charts. We've reverted to only predicting 60 days at a time because there's just so much uncertainty. And again, you look at the number of variables that are expiring here over the next couple of months. And the uncertainty regarding how fast everybody comes back from unemployment. It's just a very difficult market to predict and very hard for an operator to perform in.
Well, Kevin, thank you so much for the insight. This is a much more positive conversation than we had last time we were on Manheim Connected, but thank you for joining me today.
Thanks, Pete. Appreciate it.
My pleasure. And for Kevin Chartier, I'm Pete Grupposso. This has been another edition of Manheim Connected. Thank you for your partnership, and we'll talk to you soon.